Thanks, Deacon. The world of social change and responsibility is evolving very rapidly, and the world of responsible investing is evolving even more rapidly. When people think of responsible investing, a lot of them think of what Deacon talked about. Let's strive for that ideal. Let's invest in those new technologies that are going to manage the carbon transition over the next 20 or 30 years. And we need people thinking about that. We need people investing in those kinds of concepts that will get us where we need to want to go. But we think that responsible investing can't ignore the way the world is today. So what we've done is we've developed a product that drives positive incremental change in the world today, and we're calling it a contrarian ESG approach. So let me start by talking a little bit about what the world of sustainable investing looks like today. So today, most funds focus on what we call the consensus champions. Companies that are already great, that are unambiguously good. And as a result, they all tend to look the same, and they all tend to have some very clear skews in what they do. On the left, what you can see is how they rate in terms of ESG ratings. There are companies out there that rate corporations on how good they are on social dynamics of E, S, and G. Global sustainable funds overwhelmingly invest only in the A category of funds, the best corporates that are out there. On the middle panel, you can see they skew highly developed world, a big underweight to emerging markets. And within that overweight for the developed markets, there's an 11% overweight to Western Europe. On the right-hand side, they virtually ignore certain sectors. There are certain sectors that are very popular. Healthcare, consumer, technology are all highly overweight in these sustainable funds. Energy, that 2% that's in there, that's renewables. No oil and gas, nothing else. Mining, virtually ignored again. So that made us ask ourselves two questions. Does allocating capital towards improvers instead of rewarding performers actually do more good? And second, is there a role for investors in driving better performance in more controversial sectors or regions? What do these funds look like right now? To do this, we surveyed the 8 largest global sustainable funds that are out there. 75% of them invest in the same 5 companies: Amazon, Google, Microsoft, Unilever, and Visa. Now, we all heard the last speech. We can argue whether Amazon, Google are, in fact, doing good in the world, but the fact is that all these companies are very highly rated when it comes to ESG ratings. And when you think about it, does really allocating another incremental dollar of capital towards, say, Visa, do a lot of good for the world? On the right, they do, as I mentioned, ignore other sectors. But only 30% of the world's oil goes into passenger vehicles. So even if we move to a 100% electric vehicle world tomorrow, we still need a lot of oil. And what do you think powers your electric vehicle? It's mined commodities like lithium, cobalt, manganese, nickel. Rather than ignoring these sectors like most funds do, isn't it better to use the capital that we have to drive change and drive improvement in these companies that are still going to be around for the next several decades? Lastly, what falls out of that is a set of portfolios that are very growth-driven and very expensive. When you look at the global sustainable funds on any kind of dynamic, they are more expensive on a price to earnings, price to book, or any kind of cash flow multiple basis. So that made us ask ourselves a few questions. Can you find valuation-driven investments within the ESG space? Can you create a portfolio that has attractive fundamental and attractive ESG characteristics? And lastly, can ESG actually be a source of alpha for you? I wanted to spend a couple of minutes talking about ESG ratings, because this is the world today. A lot of firms out there rely very heavily on ESG ratings to determine for them which companies are good and which companies are bad. First of all, there's a lot of rating agencies out there. There's actually over 300 that we know exist today. Over time, they will likely consolidate down, but it's very difficult to try and figure out which one to listen to. If you actually compare the output of all these ESG rating agencies, they often disagree with each other. They'll come to polar opposite conclusions on a particular company. And they're all trying to do the same thing. So they all have to have their own particular shtick or their own particular spin on what they're doing. As a result, a lot of these ratings are very backward-looking and are very mechanical in terms of what they're trying to do. So I'm going to talk a little bit about MSCI. MSCI is the largest rating agency out there. So I'm not trying to pick on them, but the fact is most investment managers use MSCI when they're engaging in any type of rating screen. And this is how MSCI does it. So they go out and they collect a lot of different data points. Then they try and analyze different issues. So they have 37 key issues. Those are things like carbon emissions, water stress, board diversity. They break those down into 10 different themes. Those are themes like climate change or human capital management. And then they roll that up into 3 pillars: an environmental pillar, a social pillar, and a corporate governance pillar. Within each of those, what they try and do is they measure 2 things. The exposure. How risky is the environment this company is facing? How much exposure could there be to something like carbon emissions? So a miner is going to have higher exposure to carbon emissions than a bank, for instance. And then how is the company actually managing that? Are they doing a good job of dealing with the risk that they have? These are all numerical. These are all quantified. They weighted average these, and they want to be industry agnostic, so they then do something called an industry adjusted score, which is really a normalization across all the different things. And then what they do is they have a table. If you get a 4.8, for instance, you're a triple B. If you get an 8.9, you're a triple A. It's a numerical calculation that falls out of that. Most people use these, and this is the most common screening tool, and there's a lot of passive ETFs that are based around this. We think this is not the best approach to take, and let me give you a few examples of why. This is really difficult to understand. It really requires active management and deep research to truly understand what a company is doing in their responsible investing field. So one of the problems with this is it's trying to boil everything down to a same score. So let's take a company called Sasol. Sasol is a South African oil and gas producer. They make diesel and gasoline from coal. That is the dirtiest way of doing that in the entire world. They rightly get a very poor environmental score from MSCI. However, they have best-in-class corporate governance and best-in-class social. When you weighted average those 3 things, they actually come out with a pretty decent score. And maybe that's fine. Overall, the company's fine. But if you're really trying to focus on the largest carbon emitters in the world, your score using this is not going to capture that company. And let's dig into that corporate governance score a little more. Best-in-class corporate governance. What are these guys measuring? On paper, their board looks great. Separate CEO and chair, extremely diverse board, no poison pills. It looks great on paper. Take a look at the stock price of Sasol over the past 5 years, if anyone can pull it up on their phones right now. It's been pretty bad. What has actually happened is they've got 2 CEOs. They actually fired them finally in October, but they had 2 CEOs for a number of years. The company made bad decision after bad decision after bad decision with a corporate culture of always saying yes to the top people. It was a dysfunctional board that had in no way any control whatsoever over the CEOs. On paper, it looked great, got a good rating, did not create any value for shareholders or for the people who worked at the company or for the people of South Africa. The second thing the ratings do is they're very backward looking. MSCI averages 5 years of historical data. A company can change a lot in 5 years. So if you're looking at the ratings, what you're getting is a picture of the way the company was on average about 3 years ago, not today. And lastly, these companies, these rating agencies, what are they doing? They're looking at things they can measure versus things they should measure. Because should measure is hard. It requires work. It requires one-on-one conversations with the CEO, with their head of sustainability, with their head of supply chain management. The rating agencies can't do that. So they measure what they can, which is usually disclosure. Does the company have a policy on this? Tick. Does the company say they do this? Yes, they do. Companies that have a lot of disclosure and a lot of policies are often ranked as best in class. So what that means is larger companies tend to get higher ratings, and companies that are in the developed world tend to get higher ratings because the smaller companies don't have the energy to do it. I've talked with a lot of investor relations groups. The largest companies say they are currently spending 40% of the time of the investor relations department answering ESG questions. Small companies just don't have the capacity to do that. The big companies know how to tick those boxes. So we actually think the ratings are skewed. And again, I'm not trying to pick on MSCI. Most rating agencies are like this. But the point is, you need to get out there and engage with these companies about what they're doing. Just looking at a score on a page doesn't have the full picture. So that brings us to this. All these rating agencies out there, if you correlate stock returns, the companies that do well with these ratings, there's no correlation at all. The best companies when it comes to ratings aren't necessarily the best stocks to invest in. One thing does matter, and that's improvement. So what this shows is the relative stock performance of various companies against the MSCI All-Country World Index. Companies that get ratings upgrades, companies that are improving, outperform by almost 1% in the year following the upgrade. Companies that get downgrades, underperform. And on the right, what you see is the companies that get the biggest outperformance, so over a 5% outperformance, are the companies that are the worst to start with. So what we call is getting out of that CCC penalty box. CCC is the worst rating a company can have. If you can get rid of that CCC rating, you're going to do well. And we think that's for a couple of reasons. One is a company isn't just typically improving along one dimension. They're improving on multiple dimensions. So you're getting a company that isn't just doing better on its carbon emissions, you're getting a company that's fundamentally better and should be worth more. The second thing is flows. There are a lot of asset owners, clients of ours, that refuse to let us invest in CCCs. So if you've got, say, 50% of your clients that use CCCs as an exclusion, you're probably not going to put them in a lot of your portfolios. Not becoming a CCC actually gets outperformance because it drives more analysts, more portfolio managers, more asset managers to put money in that particular stock. So what are we doing? We've created a fund that we call Global ESG Improvers, and we believe it's about driving both fundamental stock performance and stock returns and driving incremental positive change for the world. It's a very concentrated portfolio. There's only about 20 to 25 stocks in it. Each one we like anyway. This is a stock we would own independently of any social responsible investing momentum that it has. The second thing it has to have is some dimension of ESG improvement or enabling. And I'll go into more details on that in a second. So what you have is the Venn diagram or the intersection of these two things. And on the right, we believe this provides us with an incremental and uncorrelated source of alpha. You have the fundamental return from these companies we like anyway. You have some kind of ESG kicker with that. As this company becomes recognized for its ESG or socially responsibility capabilities, it should get a multiple upgrade. And that should drive greater total return. Specifically, we're looking for two things. The first category we're calling unrecognized improvers. So these are companies that are the victims of these ESG rating agencies. Because the ratings are so backward-looking, they don't recognize improvement until it's already several years down the road. So what we're trying to do is find companies that are already on that path to improvement, that have already committed to making a difference, but that those ratings, and therefore the market, hasn't picked up on this yet. The second group is called neglected enablers. So as we pointed out, the global sustainable funds are all piling into the same companies. Tesla. Rather than investing in Tesla, if you're looking at electric vehicles, there are many different ways to play that. There are small companies out there that participate and enable Tesla along various parts of the value chain that trade at a fraction of the multiple of Tesla's stock price. So these are the two groups of companies that we're focusing on because we believe in both cases, as they become more recognized for their ESG capabilities, they will appreciate more than the competitor stocks. So let's go over a few examples. The first stock here is Sabesp. Sabesp is a Brazilian water utility. Water utilities are the companies that deliver clean drinking water to your tap and take away and treat sewage waste. In Brazil, drinking water, 90% of the population, not bad, but there's still 10% of people in Brazil that don't have access to clean drinking water. Sewage, on the other hand, not so good. All that sewage, rather than being treated, gets dumped in the rivers and lakes. That's not particularly good. The Brazilian government recognizes this. They are awarding very attractive contracts to companies like Sabesp that are engaging in building out the sewage treatment systems. As a result, Sabesp is growing rapidly and has very nice returns. So from a fundamental point of view, this is an attractive company to invest in. From a social point of view, this is a company that's doing good. You want your entire population with access to basic sanitation services. On the other hand, MSCI has them with a very low rating. When you look at why it's lowly rated, it's because they have a high and growing amount of water usage. MSCI says water usage is bad. Often it is. An industrial company that's using water is diverting water from uses that MSCI feels it should be, which is basic sanitation for the population. It doesn't recognize a difference between an industrial company or a miner and Sabespi, who, if Sabespi has high and growing water usage, that means more people in Brazil have access to sanitation. Our analysts put the MSCI report in front of Sabespi and said, what do you think of this? Sabespi went, this doesn't make any sense. We said, no, it doesn't, and here's what you need to do. So Sabespi is now involved in a campaign to try and convince MSCI that they should not be a single B. They should actually be credited for providing benefits to society as opposed to just using water. So this is one example of where the ratings get it wrong. Another example, this says unrecognized improver. Notice the un is crossed out. But this is Norilsk Nickel. Norilsk is the largest provider of Class 1 nickel in the world. Now, nickel is a key component of electric vehicles. It's electric vehicle batteries. It's what provides range to the vehicle, so allowing you to drive greater distances without plugging it in. That's what everyone wants. So in terms of nickel, technology for electric vehicle batteries is moving from today's 1-1-1, 1 part nickel to 1 part cobalt to 1 part manganese, to an 8-1-1, 8 parts nickel to 1 part cobalt to 1 part manganese. We're going to need a lot more nickel, not just from more electric vehicles on the road, but from this change in technology. And to enable that, we need Norilsk. They're that big. On the other hand, Norilsk is located in remote Siberia. It's about a 7.5-hour flight northeast to Moscow. I've been there. It's very hard to get to. All mining is you dig a scoop of dirt out of the ground, you throw it in a furnace, you burn away the waste dirt, you're left with the nickel ore, and anything you burned in that furnace goes up the top of the furnace and out into the air unless you have some kind of emissions technology. Norilsk was built in Siberia in the 1930s and 40s. Their soil is very sulfurous, and you can imagine what kind of emissions technology was present in Siberia in the 1940s. Basically nothing. They were the world's largest emitter of sulfur dioxide in the world. We talked to them about this for years. When we met with them, with the CEO, with the CFO, with the owner, the Russian oligarch who owns it, the first thing we led with was not, how's the business doing? It's like, what are you doing about the sulfur? They very clearly got the message that we as large asset owners care very much about this. Over time, they decided to do something different about it. They did a couple things. They upgraded their concentrator. So now, rather than throwing all that dirt in the furnace, they take it, they sift it. Some of the waste dirt goes away. They threw a third less dirt in the furnace than they did before. The second thing they did was built a new smelter in 2016. They shut the 1942 smelter at that point. So now they're dealing with 2016 emissions technology as opposed to 1942. Overnight, their emissions went down by 35%. They're still a big emitter, but this is real, tangible change to the world. The next step, which we're on their case about now, is sulfur capture. So they have a plan to reduce this by another 75% within 2 years. And by the way, this wasn't just all about reducing sulfur. By throwing a third less dirt in the furnace, you use a third less energy. That's cheaper. Operating a furnace that was built in 2016 as opposed to 1942, much more efficient, requires fewer employees, much cleaner. There are operational and cost savings benefits associated with this also. This is an all-around win for the world and for Norilsk. After they did this, it took them about 2 years to get the upgrade from MSCI to become recognized that their emissions were not as bad as they were before. They outperformed pretty dramatically after that point. The last example I'm just going to show you is the neglected enabler. So SQM, this is a Chilean lithium producer. Lithium is another key component of lithium-ion batteries, which are what powers electric vehicles. Most new lithium in the world today, and lithium mining is growing very rapidly because electric vehicle demand is growing very rapidly, is come from Australian hard rock. These guys are Chilean brine. It's a very different way of producing it. It's about a third better, or sorry, 2/3 better. It's about a third of the carbon emissions that an Australian hard rock banner has on lithium. So we need to grow our lithium demand. Would you rather have more Australian hard rock or more Chilean brine? Chilean brine is a much cleaner solution to what they're doing. And if you look at the way SQM trades versus, say, Tesla, another player in the electric vehicle market, it trades at a fraction of Tesla's costs. So this is our example of enabler, a company that is supporting the same positive trends, but is not as recognized as the poster children like a Tesla in the electric vehicle world. Now, let me be clear. We're not just talking about investing in bad companies and hoping for the best. This is about active research, talking to the companies, understanding what we're doing, becoming convinced by meeting with the Russian oligarch that Norilsk is in fact doing this. So let me give you an example of a company that's not doing it. Southern Copper. This is a copper miner. In case you didn't know, copper is what powers electricity. Behind the walls, in your cell phone, in an electric vehicle, there's a lot of copper. An electric vehicle has about 3 times the amount of copper in it that a regular vehicle does. Copper is necessary to electrify the world and drive more of the power that we're going to need to power all the electric vehicles. Southern Copper has long been a darling of the commodities investors. It has long life, low-cost mines. It has historically traded at a very large premium to most other copper mines. On the other hand, Southern Copper has been pretty bad at ESG. They have a very poor environmental track record. They usually have at least, I've averaged it over the past 7 years, 3 finable spills per year. That's way more than most other miners. They have poor labor relations. At one point, one of their unions went on strike in one of their mines in Mexico for 3 years. The reason it went on strike? There's an explosion in the mine that killed 60 miners. And before anyone could go and see what happened, Southern Copper shut off the power so no one could go rescue the miners. The army had to eventually come in and get the miners out. As a result, they have very poor relations with local communities. No one wants a Southern Copper mine in their backyard. Would you? They have spills. They don't treat their employees well. No one wants one. They've got a mining project in Peru called Tia Maria. Startup date on that mine, 2010. It is still not up and running because no one wants it. To date, 16 people have been killed on site protesting against Tia Maria. But nothing happened to this company because they were delivering long life, low-cost copper. This came to a fruition about last year, a couple of years ago now. In Mexico, AMLO was elected president, and he's been shining a light on Southern Copper's practices. He's changing the mining rules in Mexico to require more responsible mining. One of his cabinet ministers is a man by the name of Napoleon Gomez Urrutu. He was the head of that union that occupied the mine for 3 years. This is now front page news in Mexico on an almost daily basis. Peru has taken this over. They have basically denied the permit for Tia Maria at this point and have said that they need to come to a social contract with the local people before that mine will be permitted. I speak with Southern Copper on a regular basis to see if there's any movement. I have to say, I'm very disappointed that they do not actually actively seem to realize that this is an issue for them. When we were talking about what they're trying to do to get Tia Maria permitted, they said, we're going to build the town and community center. I was like, okay, and that was it. Table stakes in mining in most countries is building hospitals, roads, schools, infrastructure, leaving the community with a sustainable business. In mining, when you build a mine, you get a lot of workers up front that are building the mine, then they all go away and there's very few that are actually operating it. Good companies deal with that and set up another business that the entire community can thrive on. So I said, well, what about a hospital? Their response was, well, that's our bargaining chip. If that's what it takes to get it over the line, we'll build a hospital. At this point, I'm like, okay, these guys aren't changing. So what we're looking for is meeting with companies like this to see if they're going to change, to actively engage with them, to push them to change and encourage them to change. It's not about hoping. You need to be sure they're going to do it. And what you can see is as these issues became more broadly recognized, Southern Copper's multiples collapsed. It trades still at a small premium to its peers, but not a huge premium. So just a little bit more on our product. As we said, it's a 20 to 30, 25 stock portfolio, very concentrated, where we are trying to pick off the companies that are both fundamentally attractive and have an improving ESG dimension. The one thing I just wanted to touch on is the restrictions. We've got tobacco on there, controversial weapons, but basically what we're saying is if the product is not necessary for the world today, we will not touch it. So for instance, tobacco. We've had a lot of people say, why not e-cigarettes? And this was well before all the more recent news that e-cigarettes aren't very good for you either. But e-cigarettes are an improvement over regular cigarettes. Well, you know what? The world would be a better place if all of this just went away tomorrow. You'd have some very unhappy people, but healthcare outcomes would improve, costs would go down. We won't do tobacco. Gambling, controversial weapons, there's a number of things. Fossil fuels, on the other hand, we are going to have oil for the foreseeable future. Mining, we're going to have more mining in many categories because of the drive to low carbon and for the foreseeable future. If it's something we're going to need, we won't divest. We will engage with the companies and make them do what they're doing better than they're doing it today. And in terms of costs and valuation, what this is are the 83 portfolios that have or globally sustainable portfolios that are available on a common investment database called eVestment. The dark diamond represents the global average of the MSCI benchmark. As you can see, doesn't really matter what statistic you look at, the vast majority of global sustainable funds are extremely expensive. On the other hand, Global Improvers is among the lowest cost funds that are out there on all these dimensions. And just to show, I've used a lot of mining examples because that's my background. It's not that. We have stuff across every country, not every country, a very large assortment of countries and across every industry. We have companies in there from a healthcare company in Sweden to a biofuels producer in Brazil to MIR over here, in case you guys don't know. MIR is a US company that their specialty is hooking up solar and wind farms to the grid. They're the ones laying the cables and enabling more renewable energy to happen in the US. You can find opportunities across the globe and across different sectors. So happy to open it up for questions, but what we wanted to do is try and show that there is a different approach, that not just visionary and idealistic change matters, but actually driving tangible incremental change today in a practical way also helps to make the world a better place. So what we're trying to do is invest in tomorrow's ESG leaders today. Thanks.
Am I on? I am on. Excellent. Thank you so much, Michelle. I'm sure, since this is a counterintuitive investing approach, this has sparked some counterintuitive questioning. So let's see who we have in the audience. We have up here. You're making people run.
There you go.
Michelle, really good presentation. When you say ESG, I think chocolate, vanilla, and strawberry.
Yeah.
Right? I mean, there's so totally different signals. The environmental signal, the social signal, the governance signal, in terms of predicting outperformance of a portfolio or driving excess return. If you had to select among them,
Yeah.
right, what signal do you think has the most value in driving excess return? Is it the environmental signal, the social signal, or governance?
I think that will evolve over time. And I'm going to give you two answers to that because we've done that analysis. In the emerging markets, it's governance. Most developed world countries have agreed for years that governance is good. Maybe it's not diversity, but it's good ownership, it's good voting structures, a lot of the things that tick those MSCI boxes. So most developed world countries today have at least a baseline of good governance. Changes in governance don't necessarily drive performance. In the emerging markets, there's still a long way to go. You have dual classes, you have family ownership, so you can see pretty dramatic reforms translate into stockpile in emerging markets from the G pillar. Across the board, social is the one that's driving the most difference right now. You can actually do a quantitative analysis of these particular signals, and it's social that is actually creating the most alpha today. I think this could evolve. I think there's probably a growing momentum behind environment, particularly, and this is very recent over the past year, we've seen major derating across some of the dirtier oil companies, the E&Ps, the US E&Ps of the world that are doing shale oil. We think this is probably set to continue. So you may see E become a little bit more on the forefront, but historically, G in emerging markets, S in the developed world.
Excellent. Great question. Next. Yep.
Michelle, thank you for your presentation. You had a smattering of rating agencies on one of your slides,
Yeah.
and you made the comment about them being more fragmented and really not having a standard. Do you see that standard at governance or some regulation across them that needs to happen before we can really get a good system in place to really understand that these companies are actually doing something and they're continuing to improve on it?
Yeah, so one, they are consolidating. If I were to do this 3 years ago, there'd probably be at least another 10 on that page. So they slowly are consolidating down, and they're getting better at what they're doing because they're learning. I do think you will eventually coalesce on a certain set of standards. So last November, I gave testimony before the SEC. It was the first time at the Investor Advisory Council. It was the first time the SEC had actually addressed the topic of responsible investing or ESG investing. And there were obviously varying different points of view there. A lot of the panelists, like myself, were saying that something is needed because the quality of the data coming out of the companies is not uniform and it's very disparate. Like even if you are reporting carbon, is it scope 1, scope 2, how are you calculating it? The two things that got a lot of traction there were to do with that. And it wasn't so much that they thought, and I don't see the SEC getting involved in a while regulating it, but the idea was that if you don't do it, Europe's gonna do it. And you might wanna think about it. So I think Europe is very close to coming to a certain set of standards, or at least over the next couple of years, something that will evolve. Australia, there are very clear standards that what we have to report on modern slavery or emissions. I think they're coming. The second thing was the amount of time companies are taking. Companies are spending 40% of their time because people like me are going around asking them questions, and we all want different data, or we all want the same data in a different format. The companies themselves are asking for it. They're saying, look, we'll give it to you, just tell us, can you guys agree on a certain standard? So SASB, the Sustainable Accounting Standards Board, has a reasonable framework for looking at it. Is it perfect? No. Does it drive in the direction of creating value and reporting on many of these dimensions? It does. We would encourage something like that, at least as a starting point. You know, it's taken accounting rules decades to evolve, and they're still evolving. Let's at least start with something on there. So I think, particularly in Europe, you may see something coming relatively quickly out of there.
Thank you.
Thank you, Michelle. Great presentation. Would AllianceBernstein, since your research is kind of proprietary and you guys have monetized that, would you consider making maybe that open source for other investment companies for the greater social good?
Yeah, that's a very good question. We are considering certain things, so let me name a couple. We have our proprietary eSight platform, which is a tool that our analysts use to conduct ESG research and share it across different teams in the firm. That is one thing we would consider, maybe not immediately the data in it, but the platform itself, so that other smaller managers who don't have the resources to actually go and build that to themselves can use it. The second thing is the Columbia Climate Change Training. We have a partnership with the Lamont Doherty Earth Institute there, which is on the forefront of climate change. Every investor in our firm will have gone through the training by the end of this year. I think we've done 4 sessions so far. There's one scheduled for Monday, one scheduled for June, then one further down the road. We plan on rolling it out to our clients first, and starting in 2021, it will be offered more broadly to a wider array of people. So we are thinking about that. I think in terms of some of the work we're doing, like other managers, the idea is first and foremost, something we would like to get into our funds, but if there are ways to partner, share, and like I said, share tools that aren't necessarily proprietary, we're happy to look into those.
Any other questions?
Michelle, I'm sorry being a ringer here, but toward that end and sharing and setting standards, to go back to Victor's idea of the role model halo, I'd like to ask you to speak a little bit more about how you're thinking about approaching fossil fuels.
Yeah.
Because that's such a hot button around carbon load.
Yeah, so one of my first, I became global head of responsible investing last week. So this is, pretty early stages here, but before I took the job, there were a few people I wanted to meet with. One was the CEO, just to see how he's thinking about this. And I was, pleasantly surprised at how he is thinking about responsible investing being a value creator and business winner and game changer for AB. So one of my first objectives is to develop a clear statement on fossil fuel policy. And as I've kind of indicated here, it will probably not be along the lines of divest. That is one option people do. But as I said, particularly in the realm of oil and gas, we're going to have oil for the foreseeable future. 30% of oil is in passenger vehicles. Throw in the other 12 that's in cargo ships and trains and boats and other transportation. You're still left with 58% of the world's oil that has nothing to do with transportation or electric vehicles. Rather than ignoring it, let's actually do something about it. As large stewards of capital, we meet with these companies on a daily basis. When we talk with them, we can influence the way they think. They want our capital. They want our money. They want to know what is a good strategy for them. So by having large investment managers, not just avoid the sector, but actually actively have discussions with the boards, the senior management of these companies about why we think that investing in an energy transition is not just good for the world, but good business is the way to go. Because think of it this way. If you've got a carbon emitter, if they're already taxed on it, we should be thinking about that from a valuation perspective. If they're going to become taxed on it in the next 5 years, we should be incorporating that into our valuations. Even if they're never going to become taxed, but the regulations are going to change and you are going to have to install scrubbers or other equipment to modernize, that's CapEx they're going to have to spend. That should be in our valuation. Even if that's never going to happen, is there a lower carbon alternative? The customers are going to make different decisions and that company is going to lose business. Or are employees going to look at things differently? Let me give you a stat. Royal Dutch Shell is the largest company in the Netherlands. It's always been number 1 or 2 in terms of desirability for engineering grads to go work for. It's usually number 1. Philips occasionally surpasses it, but Royal Dutch Shell has had no problem recruiting engineering talent. It's now number 8 in the Netherlands. I can't even name 6 other engineering firms in the Netherlands. But think of what that does to Royal Dutch Shell. Their investment in technology, in innovation, in operations, now no longer has the best people in the Netherlands behind that. Is that going to change the dynamics of its fundamental business model? So a lot of people think of these things as 2 different things. We don't necessarily think about that. We think these are so closely intertwined that actually acting on and encouraging and forcing companies to do better is not just good for the world, but good business sense too.
Any other questions? Actually, Michelle, I have a question. I figure if you can do it, I can do it.
Yeah.
So my question to you, do you see challenges, since this is a counterintuitive thesis,
Yeah.
and since ESG investing has largely been sort of press and play from the retail investor perspective, and because it's dominated by passive investing, is there a challenge in communicating this counterintuitive thing?
Talk to Deacon. No, absolutely. But
that's okay. I hear from him well enough.
well, I mean, what we do at AB is we say we have a 3-pronged approach. So one is our own corporate responsibility. If we're going to be asking these companies to do better, what are we doing? What does our corporate governance look like? What does our carbon footprint look like? The second is across all our portfolios, we do what we call integrate ESG, which is included in the analysis and investments making decisions like I just described with the carbon example. And then what we have is a suite of portfolios with purpose that have goals for ESG above and beyond simple risk and return. The suite of portfolios with purpose has many different types. We do have truly sustainable funds. So there are some people who have come to us and say, I would love to buy your fund, but I just can't do fossil fuels. We don't do that. We say, why don't you go talk to Dan? He runs a global sustainable fund that might appeal to you. So we have those kind of funds for people who are a bit more visionary, a bit more idealistic. This particular fund appeals to people that are more practical. We've got ones that sit in the middle. We've got more climate change funds. We have something we call Green Alpha, which is carbon neutral funds. ESG means different things to different people, and we have to have different products that are going to appeal to that range of people. So when I explain it to them, a lot of people kind of go, that's what you mean. But we recognize that this isn't for everyone. So we do have to offer services that span the array of responsible investing.
Great. Yes. Do we have a mic? It's coming.
Thank you. That was really interesting. So if I understood correctly, when the score goes up, the MSCI score, then you're seeing the performance go up as well. In general, does it hold true that the higher the score correlates with high performance? And what's the relationship look like?
There's no relationship. There's like literally no correlation. If you look at MSCI scores, higher scores, lower scores, there's no relationship whatsoever. The only thing we found is, like I said, improvement, ESG momentum, growing scores matters, but the actual level of the scores, higher rated companies don't outperform lower rated companies.
Okay. We have time for one very quick question. And I will ask it if no one else will. Okay, right there.
Thank you, Michelle. So it sounds like you have at least 20 different stocks within your portfolio. If you could just pick one stock for long-term investing, what would it be?
Sorry, if I could pick one stock for what?
For long-term investing.
Long-term
He's asking for a stock pick. Right
yeah,
now.
I need a stock pick.
It's
In this
asking for a
market.
stock pick. I don't know if I'm allowed to do that. No, any of those. No. Let me SQM, Cozon, Johnson Matthey. Check those 3.
There we go. Okay. All right. All right. In this market, I think
Yeah, I don't know about
go
today.
with caution. Yeah, go with caution. All right. Michelle, thank you so much. Let's hear it. Wonderful. All right. Thank you.